Thank you very much for the very kind of introduction by the organization committee, and it's a truly great honor for me to speak here. The title of my talk today is "What do 2 million credit lines say about the fintech lending during the COVID-19 pandemic?" And it's a joint work with Zhenyang Bao, also from Monash University. So we begin our talk by introducing the institution background. Due to the high barrier to credit access, some of the low-income households in China are excluded from traditional banking system, and their consumption needs are largely unmet. Compared with banks, fintech companies provide more flexibility for borrowers with faster processing speed and more personalized options, such as loan condition and collateral requirements. The fintech industry started in 2007 in China, and it rapidly grew into an industry with more than 1,000 companies, 60 million active users, and a yearly asset volume of about 1.5 trillion in 2019. In a country where commercial banks are mostly state-owned and there is a significant proportion of underserved markets and population, the benefit and the cost of fintech lending is yet to be documented. And therefore, we ask 3 research questions. The first one is that do fintech lenders provide customer access to credit during the pandemic? Second, how resilient are these loans to negative shocks? And third, what is the overall benefit and the cost of fintech lending? And we summarize what we have done in this paper. We use the epidemic as an exogenous shock to study the loan outcomes of bank and fintech companies. We have 3 sets of results. The first one is that fintech companies have a sharper increase in credit provision than banks after pandemic, while the loan delinquency rate increased for fintech borrowers, but not for the bank borrower. And third, borrowers are more likely to use the fintech fund to consolidate bank debt and to smooth consumption. So we first introduce our data. Our first data source is a representative sample from the database containing all customer accounts of one of the leading commercial banks in China. This bank is one of the leading national shareholding commercial banks. It owns a broad branch network covering all provinces and is among the top 10 in the banking industry based on the annual profitability and the operational scale. We also obtained a representative sample containing all credit card borrowing records before and after pandemic, and use credit card borrowing as its most comparable one with the fintech lending in terms of loan contract characteristic and repayment schedule. And our second data source is a representative sample containing all customer accounts from 3 of the largest fintech platforms in China at the time of 2019. The 3 fintech platforms are founded in 2011 and grow rapidly in the consumer lending market. Their current business scope include cash loan and consumption credit service. And these 3 firms offer several types of credit loan with different repayment process. And to compare with the bank loans, we focus on credit loan with a pre-specified maturity and monthly repayment schedule, such that borrowers are required to pay a minimal proportion of loan balance each month. For both samples, we can connect the borrower's demographic information, credit history, and the current loan contract information. So in total, we have 74,591 borrowers with bank loans, 98,127 borrowers with fintech loans, and among which 627 borrowers have both types of loan simultaneously. And we analyze the consumer lending market next. We first show the current residential address of all the borrowers in a sample across the cities. The geographic location of borrower covers almost all cities in China, indicating the representative of our sample. Borrowers are more likely to live in the coastal city and some of the central cities. And moreover, 3 groups of borrowers share very similar residential distribution. And we next analyze the demographic variable, including the borrower's age, employment indicator, high income indicator, high education indicator, and male or unmarried. And we compare with fintech borrowers and bank borrowers. We find out borrowers with fintech loan are more likely to be younger, less likely to be employed, and less likely to have high income. However, They are also less likely to have a high college degree and more likely to be male and less likely to be married. We confirm this finding using the regression such that we use a unified regression regress fintech indicator on each of these demographic variables, and we control for the city phase effect and the city time phase effect. All results hold and are statistically robust. And then next we come to the credit variable, where we analyze the loan characteristic and the asset, such that the car and the house. We also study the borrower's historical delinquency and historical balance. And we find out for the fintech borrowers, they are more likely to have default history, and they are more likely to own a car loan and mortgage, suggesting these borrowers are more probable to be constrained by poor financial conditions. While fintech borrowers are less likely to own a car or real estate than bank borrowers, and they have larger amount of loan in the past. And again, we can confirm our finding using the unified regression, where we regress the fintech indicator on each of these credit variables and control for the city phase effect and city by time phase effect. And we analyze the loan contract information that we can observe from the data sample. We have three sets of variables: loan amount, long term, and the loan interest rate. As the fintech companies grant more amount to the fintech borrowers, a fintech loan amount is about 2,100 more than a bank loan, and the maturity is about 4 months shorter than the bank loans. We further explore the difference of loan contract features by regressing the loan amount, long term, and loan interest rate on the fintech borrower indicator. And we find out when we controlling for the loan maturity and loan amount, the interest rate for fintech on average is about 2.64% higher than that bank loan. And then we move to the empirical methodology. In this, we combine all the fintech and bank loans together and apply DFID specification as below. And our specification identifies the impact of the pandemic from the time series change in the loan outcome for the individual borrowing from a particular financial intermediation. On the left-hand side, we have the loan outcome for a borrower living in the CTC and the month T. And we also define the after indicator that equals to 1 if the time is after January 2020. And also the fintech indicator that if a borrower had a fintech loan. We also include the observed control variable, including demographic, credit, and the loan characteristics. Moreover, for most of our results, we also show the empirical result include the city phase effect and the city by time phase effect that allow us to rule out a series of identification concerns. For instance, the city phase effect captures the time environment city level attribute, such as trend and cycle associated with the credit condition for each city. They can also observe potential change in the economic policy, including the government subsidy targeting citizens living in certain cities. And the city time phase effect absorb any time varying changes at the city level, including the shock in the credit demand and change in the job activity. And the error term in here is double classing at the time and the city level, accounting for the serial correlation in the loan outcome and the possible correlation of borrowers' behavior in the same city. And we show 4 sets of empirical results. The first one is related to the loan quantity for each borrower. We begin analysis by showing the unconditional credit access before and after the pandemic outbreak for fintech and bank loans. The horizontal axis measures the time related to the outbreak of COVID-19 in China in January of 20. The event time t equals 0 represents the month when the disease first hit China, and the negative and positive number represent the months before and after the outbreak. The vertical axis measures the log total credit received by each borrower, and we plot average value of log total credit access and the corresponding 95% confidence interval around. As shown in this figure, the demand for fintech and bank loan increased after the pandemic outbreak, while the magnitude for the fintech loan is significantly higher than that of the bank loan. And we further confirm our result by investigating both extensive and intensive margin to study how the pandemic affects the probability that a borrower will receive any credit from either fintech companies or the bank, and conditional on the borrower receive any credit how the pandemic affects the loan quantity. And we report the coefficient on FinTech time after using our baseline diff regression with 4 dependent variables. A dummy equal to 1 is the borrower received any credit in column 1 and 2, and the number of loan originated in column 3 and 4, and the log value of loan amount in column 5 and 6, and log total credit in columns 7 and 8. All our estimate of coefficient indicate all measures of credit access increase for FinTech borrower compared with bank borrower and after pandemic, and the effect is both economically and statistically significant. And later, our second result is related to the loan quality. We begin analysis by showing unconditional delinquency rate before and after pandemic outbreak for both FinTech and bank loan. We restrict the loan level sample that start before July of 2019 and end after June of 2020 to study the impact of the pandemic on the loan outcome. And the vertical axis measure the average delinquency rate for the FinTech and bank loan, and we plot the mean delinquency rate together with a 95% confidence interval around. As shown in this figure, before the pandemic outbreak, both the bank and the FinTech loan have very similar delinquency rate, about 2% to 5%, and there is no statistical difference for each monthly comparison. After the pandemic, the rate for bank loan remained at the same level, while the rate for FinTech loan jumped up sharply and become significantly higher than that of bank loan. Remarkably, 5 months after the outbreak, the delinquency rate for FinTech loan exceeded 20%, but the rate remained 4% for the bank loan, and such difference is significant in economic sense and statistical sense. And we confirm our result using definitive approach. In the first column, we report the FinTech loan about 8.2% more likely to delinquent than bank loan after pandemic. In column 2, we control for observed variables such as demographic, credit, and loan contract characteristics, and the result still hold. In column 3, we control additionally for the city fixed effect and city by time fixed effect, indicating our results are not affected by the city level attributes and time varying city level heterogeneity. To taking into account the potential nonlinear effect of loan amount and loan maturity on loan performance, we add 2 beam fixed effect and show similar results. Overall, all specifications show that FinTech loans underperform significantly compared with bank loans after pandemic. There are 2 major concerns with our previous result. And the first one is there exists ex-ante difference in the borrower's characteristic and the credit attribute for the FinTech and the bank loans. We address this concern using propensity score matching method and entropy balancing method. For the propensity score matching method, we estimate the probability regression using the FinTech loan indicator as a dependent variable and all demographic and credit variable at the time of loan originated as independent variable within each city. So we find out using the nearest neighborhood criteria to select the matched sample between FinTech and bank loans. All our results still hold, and later we confirm our finding using the entropy matching method, which generalize the PSM method and reweight loan level sample such that the pre-specified moment conditions are satisfied. And in the loan level sample, we only consider the first and second moment of demographic and credit variable. And the second concern of our result is that we do not have all FinTech and bank account for each borrower in the sample. And we address this concern using the seemingly unrelated regression that take the potential correlated error terms across FinTech and bank borrower into account. We apply this method using the propensity score matched sample, and all our results shares highly similar economic and statistical significance. So what drives the difference in the loan performance? As we have shown, the FinTech loan experienced a sharper jump in the delinquency rate after the pandemic. And the one possibility is that the borrowers are more likely to use the FinTech funding and to consolidate their bank debt and to smooth their consumption during the pandemic. And to provide evidence on this conjecture, we focus on the borrower with both FinTech and bank loans to explore their behavior before and after pandemic and to see differential in the loan performance. As we have seen in the summary statistics, these borrowers are much more similar with the fintech borrowers. And by considering only this borrower, we can control for the potentially unobserved borrowers' heterogeneity. And we show the result in this figure. We compare the unconditional loan performance for these borrowers. We find both fintech and bank loan have highly similar rate between 2% to 6% before the pandemic. And there is no statistically significant difference for each monthly pairwise comparison. After the pandemic, the rate for bank loans remains similar as before, while the rate for fintech loans increases sharply and becomes significantly higher for the bank loans. And we further confirm our result using deep regression, as in all specifications, the results still hold as the fintech loans are 4% more likely to delinquent than the bank loan after the pandemic. So we may show that there may exist moral hazard for the fintech borrowers, and this borrower may use the fintech fund to consolidate the bank debt and to smooth their consumption during the pandemic. And later, we discuss the benefit and the cost of fintech lending. Our first set of results is on the benefit of fintech lending, which is yet to document in China. Intuitively, we compare the extensive margin and the intensive margin of credit access for borrowers with high income to those with lower income. We also compare borrowers unemployed and employed. We control for a full vector of covariates, CT fixed effect and the CT by time fixed effect to alleviate the endogeneity concern in all specification. And we show that after pandemic, the credit constrained individuals are able to obtain credit from fintech lenders are less likely to obtain credit from the bank lenders. Our second advantage is on the fintech companies' characteristic. As they are operated digitally and have no physical entity, the fintech lending can be much more accessible to new customers than bank lending that require offline verification and face-to-face interaction. And therefore, we may expect the fintech companies to provide more convenience to individuals who are urgently need a fund, especially during the lockdown period in China that begins from January to April. And in this figure, we plot the vertical axis measure the average ratio of new borrowers relative to the total borrowers for either fintech companies or the bank. In July of 2019, the growth rate of new borrowers for fintech companies is slightly increasing after the pandemic, while the rate for bank decreased significantly. The rate if we allow for analyze decompose them by income level. And overall, the fintech companies provide access to credit to new customers during the lockdown period. However, such access to credit may not be sustainable, especially the pricing in fintech loans may not be completely compensate their default rate. We follow the Gajian 2015 GFE paper and study the correlation between the interest rate and loan performance. In the column 1 and 2, we show the interest rate of fintech loan is positively correlated with the default probability before the pandemic. However, after the pandemic, the coefficient decline and are not significant, suggesting that fintech interest rate may not respond to change in the risk needs of fintech borrowers. However, this is not the case for the bank loans, and the relation is robust all the time. Our results suggest that high default after pandemic are likely to result in lower profit for the fintech companies, while this may not be the case for the bank. So we may shortly conclude our results. We find out the fintech borrowers have higher credit access than bank borrowers after the pandemic, and their loan performance deteriorates while the bank loans are unaffected after the pandemic. We explore potential channels that may expand differential such that borrowers may consolidate the bank debt using the fintech funding. And we also discuss the overall benefit and cost of fintech lending. And thank you very much for your listening.